this is a step in the right direction. We've been saying for a long time that quantitative tightening had no business being carried out in an environment where the main stress and the main worries in the market was funding of the government's deficit. So this is at least not adding to the stress anymore. And for the 2 weeks these purchases will go on for, at least this will at least alleviate that funding pressure. So you're probably going to ask me about the relatively modest market reaction. I think this is a reflection to the fact that these purchases are time limited until the 14th of October. The size is unknown. That's the second element. And the third element is that the Bank of England says in the same statement that they intend to resume quantitative tightening with exactly the same target as early as the 31st of October. So this is a step in the right direction, but too timid step. If I had to give a policy recommendation and even maybe a prognosis or a forecast of what's going to happen next, if we continue to see a lot of volatility in the gilt market, the Bank of England might have to extend these purchases.
In extending these purchases then, Antoine, you see the market had been pricing in perhaps an even more stringent a rise in rates, perhaps 75 basis points or even more. Do you think that becomes a question mark then that the bank can sort of put forward? I mean, they've used one instrument. As you said, they may need to extend it. Could they do a little bit more, you think?
Do more in terms of purchases, yes, I think they could do. In terms of hiking rates, it's not off the table that they would need to hike more. The statement that we had on Monday and the intervention by UPL yesterday, they all point in one direction, is that in the order of priorities by the Bank of England, when you look at it through the prism of financial stability, is first off the gilt market functioning. There is nothing worse that you can imagine in terms of financial consequences if the sovereign, the debt management office and the Treasury lose market access and aren't able to finance themselves. So that's the first order of business. That's really the crisis that the Treasury is trying to solve now. Does that mean, the Bank of England is trying to solve now. Does that mean that they don't hike as much as the next meeting? Not necessarily. UPL was also very clear that it's looking at the inflationary implications of fiscal policy. And so that doesn't preclude any intervention there.
Yeah, Antoine, just some additional news to have come out then from the UK Treasury then saying that the UK Finance Minister is indeed committed to the Bank of England's independence. So the BOE maintaining their sense of independence here. We've seen quite a bit of a let's call it a fight between the BOE as well as Treasury then. And they really have been juxtaposed to each other with regards to what to do to get the economy sort of on an even keel and an even playing field here. Do you think that this sort of statements kind of add to how much the BOE then has leverage to do in this type of market?
You're putting your finger on a very important point. And so I'm a rate strategist. My focus is mostly on the gilt market. And clearly the gilt market was caught in the crossfire between the Bank of England and the Treasury. And it's not exactly like that, but it looked a lot like they were competing or working at cross purposes. In fact, these are the words that the IMF used yesterday in characterizing the current policy setup. So you'll have a world where we have a recession and the Bank of England is trying to cool the economy with hikes. And on the other hand, you have a Treasury that is trying to shield the economy from the recession and implementing fiscal measures that are inflationary. So you can see that both were competing and the result for gilts is higher rates.